And welcome to the show, everybody. TSP Weekly Podcast. Every week in your house, 6:30 Eastern Time, Sundays. I wonder if anybody watches it live. I mean, not live, but like as it streams, as it comes out. I've never really paid much attention. I guess we could just go on YouTube and see how many people are watching it when it actually hits, or if people watch it later. But you guys tell us in the comment section, when do you watch this thing? Do you watch it, in the morning when you're brushing your teeth?
Listening to it on the way to work? I mean,
yeah. It'd be kind of hard to look at these charts while you're driving to work, but maybe.
Well, hopefully I'm not causing any traffic jams on this one because there's going to be a bunch of charts.
Oh, boy.
But they're all pretty good. There's always a lot of charts, but there's some interesting stuff happening this week, and some interesting stuff happening just in general as we start 2026 here. So TSP Weekly Podcast, 11 January 2026. We take a look at some of the economic highlights. Again, this January trifecta, Santa Claus rally, first week of January, and then the month of January is the trifecta. Then we're going to go over the 60-40 portfolio because there's a lot of talk in the financial media now about maybe the reemergence of the 60-40 portfolio if bonds do well in 2026. And then we'll take a look at ratio analysis to kind of get an idea of which you use ratio analysis to figure out which funds are outperforming the other funds. So we'll take a look at that, and then TSP fund direction. So the 3-month and the 6-month bond auctions both sold at a little bit lower rates than the last auction, which was good because last week this was basically the same slide, but it was a little bit higher rates. So we talk about this all the time, and I just wanted to kind of drill down into it a little bit. This is a 3-month Treasury bill yield. So it's a really small time frame, right? So the bond rolls over every 3 months. They call that the short end of the yield curve. And that's the part of the yield curve that the Fed really controls. So this was September 2024. That was the beginning of the Fed rate cutting cycle. And so when the Fed cuts the Fed funds rate, it expects the bond market to follow and bond yields to go down. And that is what happened on the 3-month Treasury bond yield, right? It went down over that time period. The Fed has done, I think, 6 cuts since this first one here in September 2024, and it has pushed the short end of the yield curve down. When you go to the long end of the yield curve, this is a 20-year bond chart. So 10-year, 20-year, 30-year are the ones that most of us really care about because those are the bonds that affect mortgage rates, credit card rates, car loan rates, things like that. So those are the rates that we care about. So when they say the Fed is cutting rates, for our purposes, the bond market has to play along, meaning rates need to come down on the long end. Otherwise, it really doesn't affect mortgage rates or car loan rates. And so this was September 2024 when the Fed started cutting rates. And you can see rates have gone up since the Fed started. The long rates, right? The long end of the yield curve has gone up since the Fed started cutting rates. We'll take a look at it on the F fund chart at the end, but this is basically the yield curve that people really look at, and it's gone. It's been in this channel, right, for a long time. So if rates go up, that's mortgages, car loans, everything goes up. If they go down, then everything goes down. And it's been in this channel for a long time. So at some point, it's going to break one way or the other. Not much point in guessing about it, but it's definitely something worth paying attention to. But the point of this is the long end of the yield curve is not playing along with the Fed.
Yeah, isn't that frustrating, though? I mean, I think it's got to be for most people that have no idea what we're talking about right now, right? Let's just say, I mean, you just explained it well, right? But most people, it took me a few years to kind of wrap my head around because it normally, I wouldn't say normally, generally did follow together, right?
Yeah.
Right? It did, is correlate the right word?
Yeah, correlate,
always mess that up. That's why I was never good at statistics. It generally correlates, right? And so that can be very frustrating for someone out there who really isn't kind of dialed in to all this, financial speak. And then they're like, oh, the Fed lowered rates, and they go out to buy a new truck or a car, and they're like, but nothing changed. As a matter of fact, it's worse. Like, the rate's higher. What's going on?
Yeah.
They don't understand it. I was talking to a realtor last night, and she was like, she does understand, but it's just so frustrating for her to explain to her clients why the housing market is the way it is, why rates haven't come down. When they think rates, that's what they're thinking, just like you said before. You ask the average person, when the rates go down, what do you think? Oh, mortgage rates and, car loans and loans in general, right? And that's not actually what's happening. So it's very confusing for people and frustrating.
It's frustrating when I hear it on the radio. I mean, I heard this clip on NPR the other day, and this guy, sounds very smart. And these people, when they're on the radio, they talk with authority. And he's talking about how the Fed's cutting rates and mortgage rates are coming down, and, the economy's getting better. I'm like, you have no idea what you're talking about. I mean, you sound good, but it's not true.
Yeah, wouldn't that be? I mean, we need this for a lot of reasons, but there needs to be like a meter on the television that's like a lie detector, or at least like a BS detector, because he's probably not lying. He just doesn't know any better.
No, he's just like everybody else. He thinks the Fed says rates are coming down, then rates are coming down. It's just not happening.
Right. All right.
Anyway,
I think we've beaten that one to death enough.
Yeah.
But it is something to understand if you're listening to this.
Well, I wanted to go over it because we talk about it pretty much every week, and I'm not so sure that people really understand what I'm talking about. It's complicated, I mean, once you see it and you understand it, it's fine. But the long end and the short end of the yield curve is some mumbo jumbo that doesn't make any sense until you actually understand what it means. Private sector employment. So this was from ADP. Private sector employment increased by 41,000 jobs in December after a 29,000 loss in November. So this is kind of the takeaway. This is a 5-year chart. After COVID, we had a whole bunch of employment. And then, we had a big spike in employment, and then it started rolling down. And then, early 2023, it basically flattened out. And it means this does not include government sector, right? This is just private sector. But there has not been a lot of growth in private sector employment. And this is the concerning part right here. So while it did tick up this month, relative to last month, employment is not good. Companies are not hiring. Manufacturing. So the economy is two halves, basically, right? Manufacturing and services. So manufacturing fell for the third consecutive month to continue a declining year. Basically, 2025, it declined for the whole year. Below 50 is contracting, and above 50 is expanding. So this is a 10-year chart. If you're above the 50 level, the manufacturing side of the economy is expanding. We haven't, other than a couple of months, we basically have been below that 50 line since 2023. And it's declined throughout 2025. So when, you might hear the term, we're in a manufacturing recession. That's what that means. When for a long time, we're below that 50 line, you're in a manufacturing recession. Services is the other half, right? So services increased for the third consecutive month. Services is really the only thing that's kind of keeping us out of recession at this point. And again, below 50 is contracting and above 50 is expanding. At least the average, right? Here's the 50 line. So at least going back to 2023, we have a lot more months in above the 50 line in services than we do in manufacturing. And at least the last 3 months, services has been on an uptick. So services really is the thing that's kind of keeping us out of recession right now. Let me get jolts is the job openings. Okay, so the number of openings that are being created has been very weak since April 2024. So the problem with that is if layoffs continue to rise, there are very few jobs available to absorb the people that get laid off, right? That's the problem with JOLTS being low. So again, back here after COVID, we had a whole bunch of job openings, and then they slowly trickled off into 2024. And I mean, anything really below 10,000, not 10,000, say 7,500 anyway. I mean, we have not been creating a lot of jobs. There's not a lot of open jobs, and it's been declining for the last 3 months. So if layoffs start happening, again, there's nowhere for people to go. But okay, it's Friday. So if the biggest headline news today, Friday, was the unemployment rate somehow fell from 4.5% to 4.4%. How that happened, I don't know. I haven't figured it out yet. But this is kind of what it looks like on a 3-year chart. The unemployment rate obviously has been going up, and that rate of increase is pretty alarming, actually. We didn't have a number for October because of the shutdown. November, we ticked up to 4.5 and then came back down to 4.2 in December. So as long as the trend is still going up, at some point it's going to be a serious problem because there's nowhere for unemployed people to go. If there were a lot of job openings and the unemployment rate was going up, then maybe people are getting picky or they have a lot of savings and they don't need to get another job or whatever. But when there's no job openings and unemployment is going up, you get a problem really fast. Okay, so the January trifecta, we had Santa Claus rally is the last 5 trading days of the year and then the first 2 trading days of the following year. The average rally over that time period is 1.3%, and it happens 80% of the time. We did not get a Santa Claus rally this year. If you go back to those 7 days, the market was down a little bit, so we did not get a Santa Claus rally. But unless something drastically changes today, the first week of January, first full week of trading in January, is definitely going to be up because it's a good week. The market's definitely rallying on at least the headline number of unemployment going down. So the first week of January is going to be a good week. And the saying goes, as goes the first week of January, so goes the month. And as goes the month, so goes the year. So hopefully this week ends well, and it's a good omen for the rest of the month, and January ends well, and then the year ends well. That's the idea. However, if you broaden sort of the concept of it out, right? I mean, it's kind of ridiculous to think that the last 5 trading days of the year and the first 2 trading days of the following year really matters that much in the big scheme of things. So what I wanted to do is just kind of broaden it out to the idea that if you have weakness going into the beginning of the year, that's when you tend to get, more weakness later in the year. Okay. So 2001, that was the beginning of 2001. The market's pretty weak going into it, and it rolled over, then we had the tech collapse. 2008, market's pretty weak going into January, right? 2007 was not a good year. And then we had the housing crisis in 2008. 2016, you get the market pretty weak going into it, and we had a pretty big dip in 2016. And then 2022, we get a bunch of churning right here going into the top, and the market rolls over the very beginning of January 2022. 2025, you get the same kind of churn at the top in 24 going into it, and then it took, 6 weeks or so, and then we had that decline that put in the April bottom in 2025. And then this year we got this November, we had a pretty rough November, and the market is trying to, churn itself back higher. But it's pretty similar to these areas back here where we had problems at the end of the prior year and then going into the beginning of the year. So it's just something to keep on the radar. Okay. 60-40 portfolio. So I'm sure everybody's probably heard of that. 60-40 portfolio is generally 60% stocks, 40% bonds, and you just let it ride, right? So This is what that would look like in TSP. If you did 60% in the C fund, 40% in the G fund, or sorry, the F fund. So the F fund is bonds. It's the aggregate bond index. It's the standard by which bonds are kind of compared in the United States. So this would look a little bit different if you went to the, if we use the G fund, because it always goes up a little bit. But the 60-40 portfolio for most people are 60% stocks, 40% bonds. So the S&P represents stocks, the AGG represents bonds. So if we go back to 2003 and you look at this chart, you're like, well, if this is the S&P 500 in blue, and this is the aggregate bond index down here, and they're a percent, it's a percentage compared to each other. So the S&P is up 594%, right, since 2003. The AGG is negative 2% since its inception in 2003. So if you were in the F fund the whole time, you are negative 2% today, while the S&P is up 594%. So you might look at that and go, okay, how does it make sense to do a 60-40 portfolio? Because if only 60% of your allocation is this and 40% is that, your performance is like somewhere down there, right? It's kind of a hard pill to swallow if you look at it that way, and you're like, well, I'm doing what the industry tells me to do. 60-40 portfolio is probably has been the industry standard until 2022. But if you kind of zoom in a little bit, we're just going to look at three of these. This is the top in 2007. Okay. So again, the blue line is the C fund. So from the top in 2007 to the bottom in March 2009, the C fund was down 56%. Over that same time period, this is the F fund. So it actually rose slightly, right? That's the bottom in the stocks. This is the top in stocks. So the F fund rose slightly. So let's call it flat. If you lost, the C fund lost 56% of its value, if you had been in the F fund over that time period, you would have lost less than 60% of that decline, right? So you would have been down, but maybe you'd have only been down to there, right? So the F fund was doing exactly what it's supposed to do. That's an example of the value of the 60-40 portfolio. We had the same kind of thing in 2018, right? Here was the top in 2018. The C fund was down 17.5%. This is where the F fund was at the top for stocks. And this is where the F fund was at the bottom for stocks. So again, bonds did exactly what they were supposed to do. Okay. And then if we fast forward to 2022, this is where people really got crushed, because that was the top in 2022. The market was down 25%. Bonds were down almost 18%. So bonds did not do what they were supposed to do in 2022, and people got pretty crushed from it on a relative basis. So it just depends on your time frame, how you want to look at things. This is a tough chart to kind of get your mind around, because if you're in a long-term 60-40 portfolio, if you had been 100% C fund, you'd be up here somewhere. You'd have to take a lot more volatility, but at the end of the day, if you were 60-40, your performance is only something like that.
But I mean, the real idea behind 60-40 is this idea of balancing risk, right? Diversification. And in general, that works. It's easy to wrap your mind around. And it definitely worked better 20 years ago, right? 30 years ago, when those two things didn't necessarily go in the same direction. If one was going down, the other one was generally going up. So it evened out your portfolio. You were never going to beat someone who was in the quote unquote right thing the whole time.
Right.
That's never going to happen, right? That's just luck. But what that's supposed to do is kind of, hedge yourself against, massive drawdowns and all that makes sense. And the crazy thing to me is, even after you showing this, is I still hear financial planners and financial advisors using the same language because it's all they know how to say, and they don't really know how to get past it. And they feel like they sound stupid to their other peers if they try to explain it. I mean, that's not everybody. Obviously, there's lots of people that talk about this the right way nowadays, like on YouTube and on the media. But, your average guy or gal sitting behind a desk at Charles Schwab is still kind of locked into that language because they don't really know they don't really know how to explain it better. And then it's going to conflict with what, Charles Schwab supervisors are telling them to put your money in. Yeah. Right. That's the real secret, right?
I mean, remind me, we'll talk about it when we get to the F fund at the very end. But if the F fund goes up, I mean, it's been going sideways since the middle of 2022, after having a big decline since 2020. So it's possible that the F fund goes up from here. And if it does, and the stock funds go up, then, then they'll come back and say the 60-40 portfolio is back in business.
If you're saying if they both go up together?
Yeah, a lot of times they both go up together. And directionally they can go up and down together. But if the S&P goes up 1%, the bond fund might go up 0.2%. But yeah, well, just remind me at the very end. We'll talk about it again a little bit. So ratio analysis. There's a lot of talk about this because the I fund was doing really well first quarter of 2025, and there's a lot of talk about the I fund here going into 2026. And so the way you figure out, which fund is outperforming the other one is you divide one by the other. It's a ratio. It's really simple. And you put it up on a chart, and you can do it in TradingView. You can do it in stock charts. And what I did on this one is the C fund divided by the S fund. Okay, so this is the ratio, which gives you the relative performance of the C fund versus the S fund. So the C fund is in the numerator, which means when the line is going down, the C fund is underperforming, right? The S fund. So from 2022 to 2014, the S fund way outperformed the C fund. And once we got to 2014, the C fund started outperforming the S fund, right? When the line's going up, the C fund is outperforming the S fund. So you guys might remember this part. There was a section in there after COVID. Again, when the line is going down, the S fund is outperforming, right? If you had gotten in at to the S fund here and got out of the S fund here, and it was only 6 months or something like that, you made 100% gain on the S fund. It was crazy because all the money being pumped in. Yeah, it was before the AI bubble started, right? It's COVID, all that money was going to small caps, and the S fund just exploded past the C fund. But then once 2021, the C fund again started outperforming the S fund. Okay. So this is a weekly chart. So you're trying to get your mind around, because there's a lot of volatility here. I mean, it's pretty obvious that the trend is up, meaning over time the C fund is outperforming, but you have all those little downtrends, which is S fund outperforming. So on a day-to-day basis, you might look at the TSP and go, oh, C fund's up, but the S fund's way up. And then the next day, the C fund's way up, and the S fund's not up so much. So how do you possibly get your mind around which one is actually outperforming the other? This is how you do it. So at least for right now, since the bottom of 2021, the C fund has been outperforming the S fund. This is the the C fund divided by the old I fund. Okay, because the new I fund doesn't go back this far, so it's better using the old I fund data. And it's relatively similar. It's not exactly the same, but it's close enough. So from 2002, the top of the ratio in 2002, you got the C fund in the numerator, right? So the I fund is outperforming the C fund. And it was outperforming the C fund by a lot into end of 2007, beginning of 2008. And then ever since then, the C fund has been outperforming the I fund. So these little pullbacks are short periods of I fund outperformance relative to the C fund. So whenever the line is going down, the I fund is outperforming the C fund. But obviously, the overall trend, if you connect the bottoms, the C fund is outperforming the I fund. This was the first quarter of 2025, right? We had a big rally in the I fund relative to the C fund, and everybody's talking about emerging markets and all that. And it stopped on a dime in April when the S&P bottomed. And then the C fund again started outperforming the I fund. So if this line rolls over, right, the definition of a trend, in this case an uptrend, is you have higher highs, right? Every major high is higher than the one before it, and every major low is higher than the one before it. So that gives you an uptrend. So right now we're looking at it and saying, okay, we have a big high in the ratio, and then we had a big low, right? If the ratio trend rolls over and gets below this low, now we have a lower high and a lower low, right? So now we have a pretty good potential long-term change in the trend. And this change in the trend, if it rolls over and goes down, that is long-term I fund outperformance. That's when you would look at this and say, okay, it makes sense on a long-term basis to rotate out of the I fund or out of the C fund into the I fund. And so that's where we are kind of on a weekly basis with that. And then the F fund, this one's kind of interesting. If you look at this, you would look at it and say, well, it looks just like a chart of the S&P 500. It does, because the F fund doesn't move that much. But the interesting one, part of it is right here. That was the 2022 bear market, and the C fund and the F fund basically performed the same for most of that year. They both went down, and they went down at basically the same rate, which is why the line is flat, right? And the other thing to remember about ratio charts, the ratio is one fund relative to the other fund. They can both be going down. If they're both going down, like in this case, this is the C fund versus the F fund. So let's see if I can, well, 2022 is the best year, but if they're both going down, but the C fund is going down less than the F fund in this case, then the line is going to go up, because relative to each other, one is outperforming the other, even if they're both going down. Does that make sense?
Yeah, it's the speed at which they're going that makes that change. So if one's going slower than the other, even though they're both going in the same direction, you're still going to have a line going up or down.
Right. You have a line going up or down, but you could look at your chart of the C fund and go, wait, how can the C divided by, F be going up, but I'm watching the C fund itself going down?
Well, because then the C fund is doing it slower,
right,
or faster. Sorry.
Yeah, that's the idea.
Right? Yeah.
So that's all I wanted to point out, because the ratio chart is not a nominal chart. All right. So TSP fund direction. It's a good week. I mean, it's noon, 1 o'clock on Friday, and this is a weekly chart. So we're looking pretty good on the C fund for the week. The blue line is the 20-week moving average line. The black line is the 5-week moving average line. So you can kind of see most of the time, price rides along that 5-week moving average line. When it breaks it, it tends to come back and find support at the 20-week moving average line. When we get a crossover, that's when you tend to have problems. So on a weekly basis, the C fund is looking pretty good right now. It would be good to get above that high. It's still, this is still kind of a sort of a consolidation area until we can get a little bit higher, but C fund is looking pretty good. The F fund. So this is what I wanted to talk about on the F fund. I only went back here, to 2021 somewhere. The top was actually in 2020. So this line had been coming down for a while. We've been in this kind of sideways consolidation since roughly the middle of 2022. And so the idea is of the 60/40 portfolio we're talking about, if bonds rally, if the F fund starts moving higher and stocks continue higher, then the media will come back and say the 60/40 portfolio is doing what it's supposed to do. It's great. If bonds break to the downside here, especially if stocks also follow, then we're going to have like another 2022 scenario, and the 60/40 portfolio will be in trouble. But the big perspective of this is that back here in 2020, when the F fund was at its high, it's because interest rates were basically zero. And when rates go down, the price of bonds goes up. So if rates are basically at zero, they can't go any lower. If they can't go any lower, you're at a top. I mean, mathematically, you're at a top. So this shouldn't have been a surprise to anybody. I mean, how far it comes down is, debatable, but once rates start going up, the price of the F fund goes down. So it did its first leg down. And then it's been in this sideways consolidation. Generally, this is what's called a bear flag, because you got your first move down, you got a consolidation of that move, and then you get another move down, is generally what happens. It doesn't always happen, but generally that's what happens. So it's entirely possible that the F fund has another leg down, because the move up went from 1980 something, when rates were like 16, 17%, and they came all the way down to zero. And so that was when rates are coming down, the F fund is going up. So the F fund rallied from the 1980s to the top in 2020. So yes, this was a big move down. Now we have a consolidation. And could we get another big move down? Yeah, because in the big scheme of things, it hasn't corrected very much. All right, hopefully that's not too wonky, but that's kind of an example of the kind of analysis we do for our subscribers. So if you like that kind of stuff, hit us up at growmytsp.com.
Yeah, I want to kind of dive into the 60/40 a little bit. We kind of got through everything, because I think if you're watching this right now, and maybe if you haven't been watching us for a while and you wonder, like, where do we fall into that kind of the idea of portfolio management? Like, what should I have in my investment portfolio? And specifically in the TSP, right? You only got 5 choices. So it does get pretty simple. So if you followed like the 60/40 rule, that would mean generally, like you said earlier, 60% C, 40% F, and you just let it go, right? The 60/40 kind of idea is you don't change. You might rebalance, right? Because as time goes on, the percentages get out of whack, so you have to rebalance that, right? But you would only do that if you are generally a passive investor, and you should look at it like once or twice a year and get on with your life, right? That is not necessarily what we recommend. It's probably the opposite of what we recommend, right? And so a more active approach would be, generally the way we look at it, and I'll let you explain it because you do it better, Jerry. But if the stock funds are going up, any of the stock funds, we generally want to be in them. We don't know which one is going to be doing better than the other, unless you've got a ratio chart that's clearly telling you, right? Like Jerry pointed out earlier, if it's clear that the S fund's going down and the C and I are going up, okay, well then maybe it's C and I, right? 50-50. If all 3 of them are going up in general, okay, well it's 30, 30, 33, 33, 34, whatever, right? But we want to be in those stock funds when they're going up. And then when they're not going up, the trend changes. You want to protect that what you have, right? Try not to lose any money. So if you've got a drawdown going, you pull back into the safety of the G unless the F is going up. It's really simple. And that's really the basis of our kind of approach to managing your TSP. And but you have to be active. You can't just ignore it. You can't just not look at it. You've got to be looking at the market. And so that's the part that makes it hard. And that's the part we try to fill in the gap, right? So we try to not only, educate folks. We've got tons and tons of courses that show you how to do this stuff, but we kind of sit alongside you and let you see what the models are doing when the market changes, right? And so I just wanted to kind of give a little synopsis of all that so people understand what the differences are.
Yeah. No, I agree 100%. Most people are, what they call buy and hold. And you could be buy and hold. If you were buy and hold in from 2002 to 2008, as you remember, a lot of people were buy and hold on the iFund. And that was great until it wasn't. iFund got absolutely clobbered, way worse than the C Fund in the in the housing collapse.
Right. But as long as you were watching and you moved, you were fine.
Right.
Right. If you said, "Oh, I'm I or die," which is what a lot of people were saying back then, and now it's like I'm see or die. Right. I'm all that. What really fascinates me is when you are all in, never changing. Then why are you even talking about it? Like why are you even looking at the market? Why do you care? Right. If that's your philosophy is I'm 100% C until I retire, well, then don't even pay attention to the market. It's useless, right?
Yeah, no, what happens is that at some point, if maybe it's 10%, 20%, 50%, at some point you're going to look at your account balance and go, all right, I just lost. I mean, I say lost. My account balance is 50% less than what it was a couple of months ago.
Right.
Maybe I should start thinking about like I want to retire next year. I'm not going to be able to do it on half the money, right?
Right.
But you can't think about that when you're in the position. You have to think about it before it happens.
Yeah, not only that, but you have to I've lost my train of thought. Yeah, I mean, so you have to be paying attention and you have to be willing to take money off the table, right? So maybe it's not an all or nothing game either, and that's
Right.
something else I think people forget, right? And so let's say that you start seeing, take a look at the market once a week. You start seeing the trend changing and it's starting to kind of creep downward. There's nothing wrong with taking 50% of your money off the table, putting it in G. It's still positive, right? G fund doesn't go up as much as everything else if the stocks are going up, but it's still going up. It always goes up and to the right. It can't go anywhere else, So there's nothing wrong with that. So I don't really want to beat this up, and I know it's the end of the podcast. Maybe people have already turned it off, but I think this is some of the best, stuff is to get people to understand that you can play this game without gambling, right? So we don't try to predict the market. We're not trying to time it. We're just responding to it. And so if the market is going down 10, 15, 20%, you got two choices. You either watch it and to wait for it to come back, or you take some money off the table. Maybe you take it all off the table and just wait till the trend changes and get back in. Nothing wrong with that. You're not going to beat the market that way, but you are going to protect your money. And it depends on, this is what I was thinking, I forgot. What really depends is if you take that 20% hit early in your career, you can probably recover from that, right? The market does generally go up, right? It will come back. We hope. It'll be bigger problems if it doesn't come back, right? In the term of a career. But what if you're at the end of your career? What if you're in the middle of your career and you want to start making some decisions with that money? I wouldn't take it at any point in my career, but it does matter the timing of that 20% drawdown, or God forbid, more than 30% drawdown. And we've had those, right?
Yeah, that's the thing. I know people don't really think about very much right now. The market is extremely overvalued, and so if you look at 10-year chunks, if the market's undervalued, it's much more likely that prices are going to go up over that 10-year period. They'll go up and down. But if you come into a 10-year period where the market is way undervalued, like 2009, for example, it's very much more likely that the market's going to go up from 2009 to 2019 than 2007 at the top to 2017. And actually, it took from 2000 to 2013 to get back to even. So if you're retired, I mean, it's one thing to say that, you're young, you're in your career, you're in your 20s, and the market's going to come back and all that, and it does over time. But there have been plenty of 10-year chunks where the market, had big drawdowns and took 10 years to recover. So if you're retired and you're making withdrawals from TSP and the market's going down, I mean, that's the worst position you can be in. So people listen to this, if you're 25, it's one thing. If you're 60, it's a completely different thing.
All right, guys, like Jerry said, if you like this kind of stuff, check out our website, growmytsp.com. If you have any questions or comments, put them in the comment section wherever you find the video. If there is no comment section, you can always shoot us an email at support@growmytsp.com, and the support team will get it over to us, and we'll do our best to answer it. Maybe we'll talk about it on the podcast. We love getting questions and comments that we can actually talk about on here, because if you have a question, there's probably 100 other people who have the same question. All right, guys, hope you guys are having a good start of the year. Hopefully you're still following your New Year's resolutions and haven't given up yet. We're only 9 days in. You can do it. All right. And we will see you next week. We're out here.